Hey, everybody, you ready to talk about some financial superheroes that are helping fight the NSF fee war? It's actually known as the CFPB. Well, what's really happening? If you look at the Consumer Financial Protection Bureau, that's the CFPB, they're a regulatory agency that was formed to ensure fair, transparent, and competitive practices for consumers when they're in the financial marketplace. Well, they are now turning their attention to the ever evolving landscape of real time payments, instant payments. And a notable proposal that's on their agenda seeks to address the imposition of what we call NSF fees or non sufficient fund fees. And it's in now the sphere of or the realm of those real time transactions, RTP, FedNow, those types of transactions. Why don't we start digging a little bit deeper into this? You see, NSF fees are traditionally charged when a transaction exceeds the account's available balance. In other words, you're trying to spend money you don't have. And they've been a point of contention in the consumer banking world for a long time now. Like, when should they be charged? When is it okay to charge? Sometimes they charge way too much. And the CFPB's proposal, what it's doing is it aims to actually mitigate the strain that is on consumers, particularly in the world of the instant payments like FedNow or RTP. Now, my question to this one is this really necessary? Now, don't get me wrong, I'm a big fan of the CFPB and what they do to help protect consumers. Sometimes I think they do a little bit too much, though. But is this really necessary? Because RTP and FedNow, they operate on a credit push basis. This means the transactions are initiated by the sender, pushing funds from their account to the receiver. The key here is that these systems only allow the movement of funds that are available. Essentially, transactions are, in a case, pre-funded. So consequently, the issue of NSF fees, it doesn't, or at least it should not exist in the context of RTP and FedNow. Payments cannot be covered by available funds and they simply should not be occurring. And if the bank or the credit union is allowing them to go out and they're not there, it's not an NSF fee, in my opinion. See, this is different than our old school debit transactions like we see in, say, things like ACH. See, RTPs, they don't pull money from your account, they push it from your account to the sender. So there's no chance of accidentally overspending because something comes in you weren't aware of, or more transactions come in than you thought were going to come in. And that happens before the system even blinks because they happen so fast. Think of it like sending a package from a secured locked vault. There's no accidental withdrawals if there's nothing there. See, this distinction places RTP and FedNow in a very unique position. While the CFPB's efforts to curb NSF fees, I do believe they actually reflect a significant step towards consumer protection in banking. I'm there with them. But these real time payment systems, they actually don't need the NSF fees because they kind of circumvent the NSF issue through their design for how they work. The evolution of instant payments not only offers speed and efficiency and some transparency, but it also inherently embeds a layer of consumer protection against NSF fees, at least. See, RTP and FedNow, they're actually, in my opinion, helping to further protect consumers and put more control into consumers' hands. If if anything should be learned and implemented from this, it's having financial institutions turn this into a win situation for their consumer, for their account holder. You want more on that? Well, stay tuned for part two of this, where the payments professor is going to explain how the CFPB and financial institutions could take these situations and make them a win for the consumer. For now, class dismissed.